$500 billion, gone, in 6.5 hours. The phones rang for hours, nobody answered. This is the story of Black Monday, the day the global financial system nearly ceased to exist. To understand what happened on October 19th, 1987, you have to understand the 5 years that came before it. From 1982 to 1987, the Dow Jones Industrial Average had risen by roughly 250%. It was the longest bull run in decades. Investor confidence was at historic highs. Money poured into equities from institutions, pension funds, and ordinary Americans who believed the market only moved in one direction. But underneath the optimism, structural cracks were forming, trade deficits were widening, interest rates were rising, and a new technology had quietly embedded itself inside the market. It was called portfolio insurance. It was a computer-driven strategy designed to automatically sell futures contracts whenever a portfolio's value fell, essentially a safety net built from algorithms. By October 1987, an estimated $60 to $90 billion in institutional assets were protected by portfolio insurance strategies. Nobody fully understood what would happen if they all triggered at once. The week before, Black Monday had already been brutal. On Wednesday and Thursday alone, the Dow had dropped nearly 10%. Nerves were fraying across every major financial center. Over that weekend, sell orders piled up. Portfolio insurance systems had been running their calculations. By Sunday night, they were ready to dump enormous quantities of futures the moment markets opened. Monday morning, October 19th, the opening bell rang at 9:30 on the New York Stock Exchange. Within minutes, the scale of the sell orders became clear. It was unlike anything traders had seen before. Many stocks could not even open for trading. The sell orders were so large and so one-sided that there were no buyers on the other side. Market makers were overwhelmed. As prices fell, the portfolio insurance computers did exactly what they were programmed to do. They sold more, which pushed prices lower, which triggered more selling. A death spiral had begun. By midday, the Dow had already fallen by more than 200 points. A figure that, at that time, would have been considered a catastrophic year, not a morning. Brokers began calling clients to deliver margin calls, demands for more cash to cover losing positions. Many clients simply did not answer. Others answered and had nothing left to give. The panic spread instantly across borders. London had already fallen sharply. Hong Kong would suspend trading entirely the next day. The crash was going global. At 3:30 in the afternoon, with 1 hour left before closing, the Dow was in freefall. Traders stood at their posts in near silence, watching numbers that didn't seem real. When the closing bell finally rang at 4 o'clock, the numbers were confirmed. The Dow Jones Industrial Average had fallen 508 points, a drop of 22.6% in a single day. To put that in context, during the Great Crash of 1929, the Dow fell 12.8% on its worst single day. Black Monday was nearly double that. It remains the largest single-day percentage drop in stock market history. Approximately $500 billion in market value had been erased in 6.5 hours. In today's terms, that figure would be several times larger. Now, the real question facing the United States and the world was whether Monday was the beginning or the end. Would Tuesday bring another collapse or something worse? At the Federal Reserve, a new chairman had been in the job for just 2 months. His name was Alan Greenspan. He had flown to Dallas that morning for a speaking engagement and learned of the crash mid-flight. Greenspan flew back to Washington immediately. By that evening, the Federal Reserve had a decision to make that would affect every bank, every business, and every citizen in America. The fear was bank runs. If investors believed the financial system was broken, they would pull their money out simultaneously. That could trigger a chain of bank failures that would make Monday look minor. Before markets opened on Tuesday morning, the Federal Reserve issued a statement. It was one sentence long. It said the Fed stood ready to serve as a source of liquidity to support the economic and financial system. Simultaneously, the Fed began flooding the banking system with liquidity, cutting the federal funds rate, and encouraging banks to keep lending. It was a message to every financial institution in the country. We will not let this become 1929. Major banks under pressure from the Fed, agreed to continue extending credit to securities firms. This was critical. Without credit, brokerages could not function, and the entire clearing system for trades would have ceased. Several major corporations announced they would buy back their own shares. This signaled confidence in the market and provided real buying pressure at a time when buyers had almost vanished entirely. When Tuesday's market opened, it lurched violently in both directions. At one point, it fell sharply again, and for a moment it seemed the intervention had failed. Then buyers returned. The Dow recovered significantly by Tuesday's close, gaining back roughly 102 points. Not a full recovery, but enough to signal that the system had not collapsed entirely. The immediate crisis had been contained, but the questions it left behind would reshape financial markets for decades. What had actually caused Black Monday? The Brady Commission, established by President Reagan to investigate the crash, concluded that portfolio insurance and program trading had been primary amplifiers of the collapse. The irony was devastating. Portfolio insurance had been invented to protect investors. Instead, when used at scale by thousands of institutions simultaneously, it became the mechanism of destruction. Other contributing factors included overvalued stocks after the 5-year bull run, rising interest rates, a widening U.S. trade deficit, and illiquidity in the futures markets when everyone tried to sell at once. One of the most important reforms that followed was the introduction of circuit breakers, automatic trading halts that pause markets when prices fall too far, too fast. They are still in use today. As for the broader market, recovery took time. The Dow did not fully return to its pre-crash level until September of 1989, nearly 2 years later. What Black Monday taught us is that markets are not simply rational pricing machines. They are systems of human psychology, automated reactions, and deeply interconnected feedback loops that can collapse faster than any individual can respond. The specific mechanisms that caused Black Monday, overconfident markets, new technologies whose systemic risks were not understood, and cascading automated reactions, have reappeared in different forms in every major crisis since. In 2008, algorithmic mortgage securities triggered a global banking collapse. In 2010, the flash crash sent the Dow down nearly 1,000 points in minutes before recovering. The pattern repeats. Black Monday remains the clearest single example of how a financial system can be brought to the edge of total failure, not by fraud, not by war, but simply by the mechanics of its own design. If you found this story worth knowing, subscribe. Every week we cover the financial events that shape the world we live in, told with the depth and honesty they deserve.